Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Outlook 2026. In this episode, we will share our views on hedge fund strategies and delve into how they can be used to diversify your investment portfolio. Equity market valuations are currently elevated, especially in the US. We believe that this will lead to larger than normal swings in sentiment, both positive and negative. And as such, it's important to consider diversification beyond traditional assets. This strategy is further supported by the fact that cross-asset correlations are low, increasing the benefit of owning a portfolio that is well diversified across asset classes. Hedge fund strategies are a critical piece of a well-diversified Foundation Plus portfolio. However, it is important to remember that risk and return profiles can vary widely within each strategy, and manager talent plays a crucial role in performance outcomes. On that note, let's explore the four different strategies at play. Let's start with global macro and CTA strategies. These managers go long and short across asset classes, whether it be equities, bonds, commodities, and currencies, often using leverage to target absolute returns. They are valuable diversifiers, but can struggle in range-bound or choppy markets. Historically, their performance is influenced by commodities, emerging market equities, and the US dollar. Given our current overweight EM assets and expectations for a weaker dollar, this space is attractive. However, high valuations and policy uncertainty mean we're maintaining a neutral allocation for now, as there is an elevated risk of being whipsawed. The second area to consider is equity long-short funds. These seek to profit from pricing anomalies by buying a cheap stock and selling short an expensive one. These strategies are generally correlated with equity markets, but they offer lower volatility, and market efficiency matters. Alpha is generally harder to find in the US, but more abundant in markets like China and India. That said, the low correlation between US sectors means that even in the US today, good opportunities are presenting themselves. Add to this our overweight to equities, and we are constructive on the outlook for equity long-short strategies in 2026. The third area is event-driven, which focuses on corporate actions like mergers and acquisitions or distressed situations. Key drivers include broad equity market strength, tighter credit spreads, and rising cross-asset correlations. With expectations for increased merger and acquisition activity and sectoral broadening, especially towards the pharmaceutical sector, we hold a constructive view on event-driven strategies. Finally, relative value strategies are similar to equity long-short, but in public bond markets, and typically perform well when credit spreads narrow and equity markets rally. However, with spreads already tight and dispersion low, the opportunity set here may be fairly limited. As a result, we're less constructive on relative value strategies within our alternatives sleeve. In summary, hedge fund strategies remain a vital part of our diversified approach. While I have covered the macro drivers, manager selection and strategy differentiation are key to capturing the benefits they can offer. Therefore, please consult with your investment advisor before making any investment in this area to ensure that the product and strategy is suitable for you. Thank you for your time. Please tune in for more Outlook 2026 videos to help you navigate your wealth journey with clarity amid global shifting currents.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.